Let's go live now to Kyle Rodda, market analyst at IG. Kyle, good to see you. Thanks for your time. Tax cuts, stimulus, well in the frame today. Bringing forward about $4 billion worth of infrastructure spending. That's what we're going to see from the Prime Minister today. Will that be enough to stimulate the economy? Is this what the RBA has been calling for?
It's probably something that they have been, I suppose, agitating for in the last 6 to 12 months. I mean, if you do look at what came out of, say, the RBA minutes yesterday in particular, was that there is this sense now that monetary policy might be coming towards the end of its, full efficacy before taking on perhaps some more extreme measures like quantitative easing, which is starting to be entertained from an intellectual perspective from the RBA. But one thing that central bankers around the world, and our RBA is the same, have been calling for quite some time is more fiscal stimulus and things that will cause some sort of structural change in the economy and really stimulate growth that way. So although it's sort of seen that for now the government will stick to its planned surplus pretty closely in the coming budget year, there is this hope that perhaps, and the RBA can agitate for this like I said, that there will be increased stimulus coming out of the next budget, because as it currently stands, it would seem that monetary policy alone won't be enough. It will be needed to see fiscal levers and monetary policy levers to lift the economy out of its currently sluggish state.
Yeah, well, I mean, the Prime Minister and the Treasurer in the last couple of days have been at pains to point out the fact that we're spending about $19 billion a year on interest. Just out of curiosity, how significant is the debt that we need to pay down after this, after we've reached a surplus?
Well, I mean, I suppose it's a really interesting debate. For starters, relative to the rest of the world, our levels of debt are actually quite low. And we still have a pretty good credit rating that would allow us to borrow at a fairly low rate for quite some time without necessarily putting that at jeopardy. Not only that, there is some talk because of basically good fortune, weaker Australian dollar and really solid terms of trade in the last 12 months or so, that perhaps the buffer will be there, the surplus will be there to be able to fund fiscal stimulus without acquiring too much debt. But obviously it always has to be something that's juggled quite carefully. I mean, we're in a much better position than, say, many European states and of course the United States as well as it comes to our debt position. We've been fairly fiscally responsible, relatively speaking, over the last decade or so. But it really does come down to the question of, what is government debt? What does it actually do for the economy? Is there sort of a level of government debt where it becomes a bit of a handbrake on the economy and economic growth? It looks, if you, I suppose, point to what the economic boffins are generally saying is that a little bit of fiscal stimulus, a little bit of deficit spending wouldn't go awry, because of course that would hopefully stimulate the animal spirits in the economy, and then obviously in the longer term drive tax revenues higher when necessary, and that happens to be the case. So that's probably the debate there. Yeah, exactly.
It's a confidence game. It's high stakes gambling. So let's get to the market. We've seen a few mixed results on Wall Street in recent days. At the close, it's about half an hour to close. The market will open today. Obviously, this won't be a big market mover, this announcement from the Prime Minister today. But I guess, longer term, if you see a trend on the markets, what's it looking? Is it positive? Like, how are you viewing this?
In terms of the broader equity market space at the moment, well, I mean, it's generally positive. It's very difficult to point anywhere at the moment and not say that sentiment in global equities is quite bullish. It's being underpinned by two things, really, and that's the fact that, despite the sort of, I guess, swings and roundabouts in trade talks at the moment, we had a little bit of good news come through about trade talks between the US and China overnight. Markets are baking in, effectively, that there'll be some sort of a trade deal coming through, and that should see that this sort of slowdown that we've seen in the last 3 to 6 months in the global economy should bottom out and improve. That's what the price and market is suggesting. But not only that, we've had central bankers around the world pretty much put a backstop under equity prices this year by cutting rates and flagging their willingness to cut rates further and pretty much their reluctance to not to hike rates anytime soon. So, I mean, you can draw that parallel with what's happening in Wall Street at the moment. And, I mean, we haven't seen the end of Wall Street trade tonight or today just yet, but it looks like they'll close marginally higher and again at another record high. And for the ASX 200, the same goes. We hinge very, very carefully on what's happening in the trade war, because obviously what happens in China is very important to what happens in Australia. But not only that, the rally that we saw yesterday on the ASX 200 was generated by the fact that the market increased its bets on RBA stimulus next year. So we are seeing this flow going into stock markets as rates on safer yielding assets fall, and there is this sort of flow into stocks as more risk is needed to be taken on. So for now, I mean, you can point to all sorts of contrarian indicators to suggest that maybe the market's moved a bit ahead of itself, but we're still seeing stocks move higher and the trend's firmly in place to the upside with positivity really reigning right now.